Financial distress. Understanding financial distress. A practical guide. Financial distress is a complex and multifaceted issue. This video aims to 1. Equip viewers with the tools to identify warning signs of financial distress in companies, and 2. Outline the key practical and legal considerations for navigating these challenging situations. While other critical areas, such as informal workouts, court-assisted restructuring, liquidation procedures, and specialized mechanisms for publicly listed companies are important topics, they fall outside the scope of this video. The primary audiences of this video are business owners, entrepreneurs, and key managers. The key objectives are 1. Recognize early indicators of financial distress in your organization. 2. Understand the immediate practical steps and legal obligations to address it. This video serves as a foundational guide to help you assess your company's financial health and take informed action. Disclaimer: the information presented in this video is for general informational purposes only and should not be construed as professional advice. For tailored guidance on financial distress recovery or related matters, please consult a qualified professional. What is financial distress? Financial distress describes an organization's inability to meet financial obligations due to insufficient revenue generation. This condition presents a strategic inflection point. While it may signal potential insolvency, it equally catalyzes operational restructuring and financial innovation. The ultimate outcome depends on management's timely response and strategic decision-making. The video outline. Objective: this video aims to equip entrepreneurs with actionable steps to identify and address financial distress. The key topics include 1. Early warning signs. 2. Immediate recovery actions. 3. Directors' legal duties and liabilities. 4. Other funding options. Under key topic 2, recovery actions, it encompasses A. Immediate financial diagnostic and cash flow analysis. B. Strategic working capital optimization. C. Strategic stakeholder negotiation for business turnaround. D. Strategic cost optimization and operational restructuring. E. Enhancing liquidity through strategic measures. Part 1. Early warning signs. Identifying early signs of financial distress is crucial for proactive risk management. Below are key indicators to assess a company's financial health. 1. Declining business and industry growth. A shrinking market or industry downturn can signal financial stress. For example, during the COVID-19 pandemic, sectors like hospitality, tourism, and food and beverage experienced severe distress, with previously profitable businesses suddenly facing losses. 2. Deteriorating profitability and cash flow. Persistent revenue declines, shrinking profit margins, and negative cash flow are critical warning signs. Sustained cash flow issues can lead to insolvency and eventual bankruptcy. 3. Aging accounts receivable and supplier issues. Extended receivables collection periods, coupled with suppliers tightening credit terms, e.g., demanding cash on delivery or advance payments, indicate liquidity problems. These constraints further strain cash flow. 4. Adverse regulatory changes. New tax laws, subsidy cuts, stricter environmental regulations, trade wars, or financial crises can severely impact businesses, especially those heavily reliant on government support or operating in highly regulated industries. 5. High management turnover. Frequent resignations among senior executives may signal underlying financial instability. In publicly listed companies, director departures, often disclosed in announcements, may cite insolvency concerns as a reason for leaving. 6. Breach of debt covenants or credit downgrades. A covenant breach can trigger loan defaults and immediate repayment demands. Similarly, a credit rating downgrade increases borrowing costs and restricts access to financing. For listed companies, a single breach may cascade into cross-default clauses, prompting lenders to recall loans or tighten credit lines, exacerbating cash flow constraints. 7. Difficulty securing financing. The inability to obtain new funding, linked to covenant breaches or credit downgrades, limits a company's ability to meet obligations or invest in recovery efforts. 8. Auditor concerns or auditor changes. While not exclusively tied to financial distress, an auditor's reluctance to approve financial statements or frequent auditor changes may reflect unresolved disputes, accounting irregularities, or potential fraud, all which raise red flags about financial stability. So, what are the potential impacts of financial distress on the daily operations of the companies? Financial distress can significantly disrupt a company's daily operations, with repercussions spanning three key categories, which are operational, financial, and regulatory. 1. Operational impact of financial distress comprise A. Supplier constraints. Suppliers may demand advance deposits or cash on delivery terms, straining liquidity. B. Production delays. Disrupted purchasing cycles lead to reduced output, delaying deliveries and harming customer relationships. C. Leadership instability. Frequent management turnover or vacancies create strategic confusion, eroding confidence among employees and customers. D. Workforce reductions. Layoffs may occur as cost-cutting measures, further destabilizing operations. 2. The financial impact of financial distress is the immediate effect is declining profitability and negative cash flow, exacerbating financial strain. Some of the impacts include A. Cash flow shortfalls and extended working capital cycles. The longer production and delivery times hinder revenue generation, making it difficult to sustain operations without additional financing. B. Reliance on short-term debt. Distressed companies often use bank overdrafts or short-term loans to cover interest payments. This measure is a temporary fix that fails to address long-term solvency issues. C. Frozen capital expenditures. Critical investments are postponed due to funding shortages, derailing long-term business plans. D. Covenant breaches and cross-default risks. Violating loan terms may trigger immediate repayment demands, accelerating financial deterioration. 3. Regulatory and stakeholder impact. Financial distress invites heightened scrutiny from regulators and stakeholders, requiring extensive disclosures and compliance efforts. A. Employee layoffs and regulatory scrutiny. Mass retrenchments may prompt labor authorities to investigate compliance with employment laws. B. Mandatory disclosures for publicly listed companies. Listed firms must address inquiries from stock exchanges, shareholders, and regulators with additional reporting under listing rules. C. Corporate governance challenges. Management must divert significant time to address governance concerns, audits, or allegations of mismanagement. Part 2. Immediate recovery actions. Outlined below are actions recommended to be taken by the management to turn around the business. Step 1. Immediate financial diagnostic and cash flow analysis. The initial phase of financial restructuring requires the development of a detailed 13-week cash flow forecast. This critical tool aligns with a standard 90-day working capital cycle for accounts receivable and payable, providing management with precise visibility into short-term liquidity requirements. The forecast enables the identification of critical payment deadlines and inflection points in the company's cash position. The implementation of a robust 13-week cash flow projection offers two primary benefits. 1. Early warning system functionality. The forecast accurately identifies the specific timing of anticipated cash shortfalls, allowing management to implement proactive measures before liquidity crises develop. This predictive capability is essential for maintaining financial stability during restructuring. 2. Strategic improvement identification. The analysis reveals precise areas requiring immediate intervention, such as delayed receivables collection. These insights facilitate data-driven decision-making for optimizing working capital management. By highlighting operational inefficiencies, the forecast serves as a foundation for targeted corrective actions. This diagnostic process establishes a factual basis for all subsequent restructuring decisions, ensuring management interventions are grounded in accurate financial data rather than assumptions. The 13-week time frame provides sufficient visibility to implement meaningful operational changes while maintaining adequate liquidity buffers. Step 2. Strategic working capital optimization. To effectively manage financial distress, management should implement a comprehensive working capital strategy across three key areas. Key Area 1. Operational efficiency improvements. Management must enhance cash flow by accelerating receivables collection through stricter credit controls and early payment incentives. Workforce optimization should be carefully executed to reduce payroll costs while maintaining critical operations. Supplier payment terms should be renegotiated to extend payment cycles where possible. Additionally, non-essential inventory and underutilized assets should be liquidated to generate immediate liquidity. Key Area 2. Financial restructuring measures. The finance team should explore alternative funding sources beyond traditional bank financing, including private credit and asset-based lending. Proactive engagement with creditors is essential to negotiate favorable debt rescheduling or temporary payment moratoriums. Existing debt obligations should be prioritized and restructured to align with the company's current cash flow capabilities. Key Area 3. Strategic restructuring options. Leadership must evaluate formal restructuring alternatives, including consensual workouts or schemes of arrangement, while considering jurisdiction-specific options like provisional liquidation. Where feasible, an out-of-court turnaround should be attempted to preserve stakeholder value. Concurrently, the company should explore merger or investment opportunities with strategic partners. As a last resort, management must prepare for formal insolvency proceedings while ensuring compliance with all regulatory requirements. This structured approach ensures methodical working capital optimization while positioning the business for sustainable recovery. Each initiative should be implemented with professional advisory support and tailored to the company's specific financial position. Step 3. Strategic stakeholder negotiation for business turnaround. A critical factor in successful financial distress recovery is early and proactive engagement with key stakeholders. Effective negotiation can stabilize operations, secure support, and create a viable path forward. Companies are recommended to consider the following strategic aspects. Aspect 1. Identify key stakeholders and assess their positions. Stakeholders, which may include shareholders, creditors, customers, and employees, must be engaged as soon as financial distress is detected. Key questions to address. A. Are they supportive of restructuring efforts? B. Can suppliers extend favorable terms? For example, deferred payments and adjusted pricing. C. Will customers commit to larger or more predictable orders? This helps companies to streamline production and cash flow. D. Can pricing be adjusted to improve margins without losing business? E. Early communication ensures alignment and identifies potential concessions before crises escalate. Aspect 2. Evaluate time constraints and urgency. Assess critical deadlines and liquidity needs to prioritize negotiations on. A. Upcoming financial obligations. Identify key repayment dates. For example, loan maturities, and renegotiate well in advance if default risks exist. B. Cash flow projections. The 13-week cash flow forecast reveals liquidity gaps, helping determine if new funding is required or if operational adjustments can bridge shortfalls. C. Business stability. Is a company in crisis mode that requires emergency measures, or can it operate while restructuring? If recovery is unlikely, what are the strategic alternatives? For example, asset sales, M&A, or structured wind-down. D. Stakeholder leverage and best alternative to a negotiated agreement. Decision-makers and or management of the companies must fully understand each party's alternatives. For example, creditors may prefer restructuring over liquidation. With this understanding, they can determine the stakeholders' leverage and improve the odds of the companies in obtaining their support. Aspect 3. Prioritize transparent communication. Companies must avoid miscommunication. Many restructurings fail due to a lack of dialogue with creditors, suppliers, or investors. Companies must build trust with stakeholders. Creditors are more likely to support a company that proactively shares challenges and solutions. Aspect 4. Engage employees and management. Maintain morale and retention of employees are critical. Employees are critical to the execution of the turnaround plan. Therefore, keep them informed to ensure continuity. Furthermore, a united management team is essential for implementing turnaround strategies. In short, adopting the strategies of early stakeholder negotiation, grounded in data-driven cash flow insights and transparent communication, these strategies will significantly enhance the likelihood of a successful turnaround. Proactive engagement helps secure concessions, maintain trust, and stabilize operations during financial distress. Step 4. Strategic cost optimization and operational restructuring. To address loss-making operations and improve financial performance, management should implement a structured evaluation and action plan that encompass below elements. 1. Business unit performance assessment. Segregate divisions by revenue and profit contribution, evaluating the key financial metrics, including return on capital employed, ROCE, return on assets, ROA, cash flow generation. Assess long-term viability by determining whether each division supports future growth or negatively impacts overall enterprise value. 2. Asset rationalization strategy. Identify underutilized or non-core assets. After these assets are identified, evaluate alternative ownership potential by asking, could these assets create more value for another owner? Furthermore, it is important to engage turnaround consultants to provide independent analysis and execution support. Companies should prioritize the sale of underperforming assets to generate immediate liquidity, eliminate ongoing losses, and improve overall business valuation. 3. Workforce optimization considerations. While staff reductions can reduce costs, they require careful planning due to A. Legal compliance requirements. There are legal requirements for staff layoffs in which employers must adhere to when conducting layoffs. These requirements vary by different countries, but the general principles to ensure compliance encompass the following key aspects. 1. Adhere to notice periods, severance calculations, and contractual terms. 2. Implement measurable criteria to minimize disputes. 3. Maintain transparency to preserve morale and reduce legal exposure. For complex restructuring, it is highly recommended to consult legal counsel to ensure full compliance with relevant labor laws and anti-discrimination laws. B. There are also operational impacts on the remaining workforce and productivity, which need to be accounted for in the layoff exercise. C. Furthermore, there are reputational risks associated with large-scale layoffs that must be taken into consideration. Summarizing Step 4, a disciplined, metrics-driven approach to cost reduction with a first focus on underperforming assets rather than immediate workforce cuts could help create sustainable financial improvements while minimizing operational disruption. Step 5, enhancing liquidity through strategic measures. The objectives of the below measure are to improve the cash flow infusion. Measure 1, debt restructuring approaches. When addressing debt challenges, companies should pursue 3 primary strategies. Objective 1, debt reduction, that is lowering the principal amount owed. Objective 2, rescheduling. This aims to extend payment timelines. Objective 3, refinancing. This means securing new financing terms that are better than existing terms. The key negotiation points with lenders include 1. Temporary suspension of principal or interest payments. 2. Reduce interest margins and extended loan tenures. 3. Modified repayment schedules. 4. Replacement with alternative credit facilities. 5. Potential bond issuances or syndicated loans. Measure 2. Asset optimization strategies. A. Non-core asset divestment. Conduct a thorough portfolio review to identify non-essential assets, such as real estate holdings and minority investments. The separation of non-essential assets improves business focus and valuation clarity. The divestment plan of non-core assets should factor into considerations of 1. Immediate liquidity needs, 2. Marketability of non-core assets, and 3. Whether disposing of non-core assets is in alignment with restructuring objectives. B. Receivable financing. Receiving financing means accelerating cash inflows through invoice factoring. Factoring of receivables is particularly effective for government contracts, since government contracts generally have lower default risk. The benefits of factoring of receivables include 1. Immediate working capital improvement, 2. Reduced collection efforts, and 3. Avoidance of cash flow gaps. Adopting this strategy requires an extensive cost-benefit analysis because of higher financing expenses associated with receivables factoring. Measure 3. Equity capital solutions. This simply means companies sold part of their shares in exchange for fund injection. The key to successful equity financing is companies must have a viable turnaround plan. Methods of equity financing encompass. Equity financing method 1, new share issuance. This measure is suitable for early-stage financial difficulties. The advantage is it allows immediate capital injection. The downside is a dilution of existing shareholding. If shareholding dilution is a major issue, companies are recommended to consider issuing non-dilutive preference shares. Equity financing method 2, targeted private investments. A private equity investment structured as a leveraged buyout LBO increases a company's debt burden as the acquisition is financed partly through borrowed funds. While this provides immediate capital, it also raises financial leverage, potentially affecting cash flow, creditworthiness, and future financing flexibility. Private equity investors prioritize returns, which may influence business decisions post-investment. Companies should carefully weigh the trade-offs between access to capital and the long-term implications of higher debt. Equity financing method 3, rights offering. Existing shareholders were offered new shares at a discounted price in the ratio of their current shareholding. Its success depends on investor confidence in the turnaround plan. Equity financing method 4, convertible instruments. Mandatory convertibles are hybrid instruments that automatically convert into equity after a set period. They offer a strategic middle ground between debt and equity, providing capital without immediately increasing leverage or diluting ownership. The key benefits comprise: Benefit 1. IFRS equity treatment. If properly structured, they are classified as equity, avoiding negative impacts on leverage ratios and credit ratings. Benefit 2. There is no immediate dilution. Unlike traditional equity, conversion occurs later, preserving current shareholder stakes. Benefit 3. Lower cost. Mandatory convertibles typically carry a lower interest rate than regular debt. Benefit 4. Voting rights protection. It does not grant immediate voting rights, therefore maintaining management control. When decision-makers and management teams are considering implementing the recovery actions as mentioned above, they are recommended to keep taking into account the following principles. Principle 1. Prioritize lender negotiations for immediate relief. Principle 2. Asset sales provide quick liquidity. Principle 3. Equity solutions should support long-term recovery. Principle 4. Professional advisory recommended for complex restructuring. Part 3. Directors' legal duties and liabilities. When a company faces severe financial distress, that is approaching insolvency or cash flow crisis, a director's legal obligations intensify across most jurisdictions. While specifics vary by country, core principles generally include: 1. Shift in fiduciary duty from shareholders to creditors. 2. Duty to avoid wrongful trading. Duty to preserve assets and avoid fraudulent transfers. 3. Duty to explore rescue options. 4. An enhanced standard of duty of care, skill, and diligence. For the purpose of illustrations, outlined below are the legal duties of directors in financial distress under the Hong Kong jurisdiction. Under Hong Kong law, directors owe strict legal duties to their companies, with potential personal liability for breaches. These obligations arise from multiple sources and require careful navigation, particularly during financial distress. 1. Sources of directors' duties. Directors' responsibilities stem from 4 key areas as follows. Area 1. Common law principles established through court decisions. Area 2. Statutory requirements under the Companies Ordinance, Capital 622, and Companies, Winding Up and Miscellaneous Provisions, Ordinance, Capital 32. Area 3. Non-statutory guidance from the Companies Registry and Hong Kong Institute of Directors. Area 4. Additional rules for listed companies under the Securities and Futures Ordinance and HKEX listing rules. 2. Core fiduciary duties of the directors. Directors must: A. Act in good faith and in the company's best interests at all times. B. Avoid conflict between personal interests and company duties. C. Not misuse company property or information for personal gain. D. Exercise powers only for proper business purposes. A critical example: when a company faces potential insolvency, directors must shift their focus from shareholders' interest to protecting creditors as a whole. This means ensuring no preferential payments are made to specific creditors when the company cannot pay all debts. 3. Duty of care, skill, and diligence. The company's ordinance establishes an objective standard. Directors must demonstrate: A. The general competence expected of someone in their position. B. The specific skills and experience they actually possess. This dual test prevents directors from claiming ignorance as a defense. For instance, a finance director will be held to higher standards in financial matters than other board members. 4. Key risks during financial distress. Directors face particular scrutiny when companies struggle with the following. A. Unfair preferences, meaning directors make payments to certain creditors within 6 months of winding up or 2 years of winding up for connected parties, may be reversed by courts. The underlying connection includes relationships with directors or substantial shareholders. B. Transactions at undervalue. Asset transfers for less than market value within 5 years of liquidation can be challenged. This includes granting guarantees that disproportionately benefit third parties. C. Fraudulent trading. Continuing business with intent to defraud creditors creates personal liability. Even honest optimism about recovery may not protect directors if their actions appear reckless. 5. Potential consequences. Breaches to the above-mentioned requirements may lead to A. Civil lawsuits requiring personal compensation. B. Disqualification from director role for up to 15 years. C. Criminal prosecution in severe cases. D. Regulatory sanctions for listed companies. E. Reputational damage affecting future career prospects. Sharing of a practical example. If a director approves paying a family member's debt while leaving other creditors unpaid during financial difficulties, this could constitute both unfair preference and breach of fiduciary duty, with potential personal liability. 6. Protective measures. In order for the directors to protect themselves from consequences of failures to comply with above-mentioned requirements, directors should A. Document all key decisions showing proper consideration. B. Seek professional advice when financial difficulties emerge. C. Hold regular board meetings to review the financial position. D. Declare and manage conflicts transparently. E. Consider appointing independent advisors in crises. The law recognizes that business decisions involve risk, and courts generally won't second-guess good faith judgments. However, the threshold for protection requires evidence of proper deliberation and process. Part 4. Other funding option. Government financing scheme. Companies facing financial distress should proactively explore government-backed financing schemes available in their jurisdictions. These programs are specifically designed to support businesses during challenging economic conditions by improving access to credit, reducing borrowing costs, and providing flexible repayment terms. The key benefits of government financing schemes for distressed companies comprise 1. Enhanced access to credit. 2. Lower interest rates and favorable terms. 3. Debt restructuring support. 4. Serve as working capital and operational relief. 5. No or low collateral requirements, and more. If companies in financial distress are considering government funding schemes in their jurisdictions, the actionable steps for companies include but not limited to the following. A. Check eligibility and review the criteria. For example, the revenue decline thresholds, sector-specific focus, and others. B. Consult advisors. For example, engage accountants, insolvency practitioners, or industry associations for guidance. C. Compare options. Companies should assess multiple schemes. For example, guarantees and compare them with direct loans. D. Prepare documentation. For example, the financial statements, recovery plans, and cash flow projections. Conclusion and recommendations. Given the presence of strong indicators of financial distress, it is advisable to engage a financial advisor to assess the company's situation and guide stakeholders, which also include lenders, on viable solutions. Key areas of support from a financial advisor, which may include but not limited to 1. Provide an independent business review. This review evaluates the severity of financial challenges and assesses business viability. 2. Provide an assessment of debt restructuring. This exercise aims to identify feasible restructuring options based on current financial conditions and future funding requirements. 3. Assist with developing a restructuring plan. The advisor shall assist with formulating a structured proposal, soliciting stakeholder feedback, and securing alignment. 4. Assist with negotiating with the lender and the stakeholder. Advisor shall act as a middle party to facilitate discussions to reach mutually agreeable terms with creditors and other key parties. 5. Implementation of restructuring exercise. The advisor shall assist with executing the finalized plan, ensuring binding commitments from all relevant stakeholders. It is highly recommended to engage a financial advisor at an early stage. The early engagement shall enhance the likelihood of a successful turnaround, protecting stakeholder interests while stabilizing the business. Thank you for taking the time to watch this video. We trust that it provided you with a foundational understanding of financial distress for companies. We would greatly appreciate your feedback and are always eager to hear from you. Surely, if you have inquiries, please feel to contact us.